Chris, we're closing out earnings season before too long, and earnings have been stellar, absolutely stellar. The market, it's never a straight line, but the trajectory has remained,
it has
up
been
and
up.
to the right.
It has been up and to the right, and this is a great chart just because it takes into account the advanced decline line. As long as the advanced decline line continues in the correct direction, I mean, there's no real reason to expect anything other than an uptrend. Now, Ryan Dietrich points out actually, now can be sort of a challenging time period with respect to a midterm election year, which is true. And we've had we've had a decent year so far, which is good. And truth of the matter is earnings have grown faster than market multiples. So actually the market's gotten a little bit cheaper, which is interesting. I really want to talk about inflation. Everyone may be tired of talking about inflation, but dang it, look what's happening out there, okay? This is the last 30 days. In the last 30 days, you've had materials and commodities up. You've had the long bond interest rate up. You've had gold up. You've had Bitcoin up. You've had Ethereum up. So crypto, all the things that might be a dollar proxy or anything to do with inflationary type assets have been going up.
Yeah.
So
rapidly.
Yes. So that means cost inputs certainly for business, but it certainly means something passed through to the consumer ultimately too.
It does.
And so what does that do to rates is my long-term question. Here's a chart. I thought this is pretty fascinating. Hat tip to Bespoke Investment Group. This is a chart from the closing price on the first day of trading for the long bond ETF back in July of 2002 at $82.35. Yesterday, August 24th, it closed at $82.56, which is a cumulative capital return of 0.8% over 26 years?
24 years.
Now, that doesn't include the interest, okay? I know that Nick Colas from DataTrek.
Yeah, Colas said the real return from 2010 to 2019 in this bond was 8% a year.
Right,
okay?
and since then it's been like
since
negative
2020, it's been negative 4.4.
With the interest.
With the interest.
So the total return was negative 4 during that time period. Well, it's been cut in half. So what does that mean for long rates when inflationary assets are continuing upward? I mean, to me, you can't have falling rates in those inflationary assets just continuing upward. So either the inflationary assets presumably have to stop, or the bond market
there will be a tell. But as long as the government keeps spending like they do, then rates have to go up, I would think.